Silver hit $67.30 on June 5th, 2026. Read that again? A metal that printed its all-time nominal high of $121.67 on January 29th dropped below 70 in a single session, shedding 8.86% in less than 8 hours of trading. The sharpest single-session collapse since the CME Group margin hike that triggered the January liquidation wave. Year on year, per Trading Economics, silver is still up 87%. The mainstream explanation arrives in one clean headline. The Bureau of Labor Statistics printed 172,000 May non-farm payrolls, more than double the Wall Street consensus of 80,000. The 10-year Treasury yield spiked to 4.54%, and Federal Reserve rate hike probability under new chair Kevin Warsh climbed sharply with his first FOMC meeting now just 9 days away on June 16th and 17th. Stronger jobs, stronger dollar, higher rates, lower silver. That is the algorithm's three-step logic. But here is what the algorithm is not putting in its headline. 84.6 million ounces of registered silver sit in COMEX vaults this morning, the only metal legally pledged for delivery against outstanding futures contracts, and total open interest across all silver delivery months represents roughly 550 to 575 million ounces of paper claims sitting directly above that physical floor. Drop a comment right now. Tell me what you are holding, PSLV, SLV, AGQ, physical ounces, or gold, and where you are watching from. The paper price and the vault are running two completely different clocks right now. Every contract on the COMEX silver market represents 5,000 troy ounces of physical metal on paper. Registered silver is the only category that matters for delivery. Eligible silver, the 234.1 million ounces sitting in the same COMEX-approved vaults, cannot be delivered against a futures contract unless its owner voluntarily issues a warehouse warrant, and they have shown no urgency to do so. Strip out eligible and look only at registered 84.6 million ounces. Divide that number into 550 million ounces of open interest. The coverage ratio lands at approximately 15%, which is exactly where COMEX analysts define stress territory, and this market has now held at or below that threshold for 6 consecutive months, per goldsilver.ai. In plain English, for every 100 paper contracts outstanding, there are approximately 15 ounces of metal behind them that could actually settle with a physical bar. The January precedent made the stakes concrete. 33.45 million ounces vanished from registered inventory in a single week during the January delivery cycle. Roughly 26% of the entire deliverable pool gone in 7 days, per CME Group warehouse data. That pool was never refilled. The JP Morgan Chase vault holds approximately 140 million ounces of total silver, representing about 44% of all COMEX stocks. But the majority of that sits in eligible, not registered. The vault does not lie. 84.6 million registered ounces against 550 million ounces of outstanding paper claims is the physical reality of this market, whatever the paper price printed on Friday. Friday's price collapse followed a precise mechanical sequence that had nothing to do with physical silver supply and everything to do with paper positioning and macro fear. At 8:30 in the morning Eastern Time on June 5th, the Bureau of Labor Statistics released May payrolls at 172,000. More than double the Dow Jones consensus of 80,000, with both March and April simultaneously revised upward, making the 3-month advance the strongest in more than 2 years according to Bloomberg. Rate hike probability for the remainder of 2026 immediately repriced sharply. The 2-year Treasury yield climbed more than 11 basis points to 4.162%, its highest level since February 2025, per CNBC. The dollar strengthened. Algorithmic selling then activated in the exact mechanical sequence that defines every macro-driven silver sell-off. Rate expectations repriced first, the dollar index followed, momentum triggers and stop-loss cascades executed third, compressing silver from a morning open near $74 to an intraday low of $67.30, a loss of nearly 10% in under 8 hours. At that identical moment, the June delivery window, open since first notice day on May 29th, had 2,820 contracts standing for physical delivery, representing 14.1 million ounces of silver, requiring actual allocation from the registered pool at COMEX-approved vaults in northern New Jersey. That delivery clock kept running on Friday. The paper price and the physical delivery system were operating in completely separate universes, and the financial media only reported one of them. Physical delivery at the COMEX is not speculative. The entities standing for delivery in the June cycle are not retail traders chasing momentum. They are industrial procurement functions, technology manufacturers, solar panel fabricators, and institutional buyers who need allocated bars with serial numbers and vault addresses. Each standard silver futures contract represents 5,000 troy ounces. The 2,820 June contracts standing as of May 27th represent 14.1 million ounces of silver being pulled into physical custody from that registered pool. To understand what is driving that demand, look at the delivery history building across every recent cycle. Full year 2025 COMEX silver deliveries totaled 474 million ounces, more than double the 203 million ounces delivered in 2024 per Real Clear Markets. January 2026 alone produced 49.4 million ounces in deliveries, 7 times January 2024's level. February 2026 ran a 98% delivery rate. 18.72 million ounces settled physically from 19.11 million ounces of open interest. That is not a functioning futures market rolling contracts forward. That is a physical allocation mechanism running at full pressure. The Silver Institute projects total global silver industrial fabrication at approximately 650 million ounces in 2026, even after solar panel manufacturers began cutting silver content per cell to reduce input costs. Industrial users are not rolling paper contracts. They are taking delivery, loading trucks at vault addresses in New Jersey, and moving physical bars to manufacturing floors, while the algorithm prints $67 on the paper price screen. Here is the data point that cuts against the simple squeeze narrative, and this channel will give it to you straight, because that is exactly what separates real analysis from promotion. The June Vault report published on June 2nd showed total COMEX silver stocks rising by approximately 4.8 million ounces since the May 21st reading, bringing total reported stocks to 319.2 million ounces according to metalcharts.org. Registered specifically grew by nearly 3 million ounces in the days leading up to First Notice Day on May 29th, closing at roughly 85 million ounces before settling back to 84.6 million on June 1st. That growth is real physical metal being redesignated as deliverable, not a statistical artifact. But here is the full context that makes that inflow look small against the total pressure picture. The coverage ratio barely moved. Open interest remained essentially flat across the same window, meaning the denominator did not shrink to manufacture an improvement. Real silver arrived, and the ratio barely budged. 15 consecutive months of record physical delivery have drawn the registered pool from 167.7 million ounces in October 2025 to 84.6 million today, a 50% reduction in 8 months per CME Group warehouse data. A 4.8 million ounce inflow into a pool that lost 83 million ounces in 8 months is not a trend reversal. If you find this level of vault-level data useful and you are not yet subscribed to this channel, right now is the moment, because this is the specific data gap that no mainstream financial channel is closing for you, and the June delivery window is still open. Geopolitical reality is the second force operating simultaneously on this market, and it is pulling in the exact opposite direction from the macro story. On June 3rd, senior Hezbollah officials continued demanding a complete ceasefire and the full withdrawal of Israeli forces from Lebanon, according to the Critical Threats Institute. Hezbollah rejected the partial ceasefire President Trump announced on June 1st, in which Israel would not strike Beirut targets and Hezbollah would halt attacks on Israel, and resumed rocket attacks against Israeli defense forces in Northern Territory within hours of the announcement. Iran's Navy fired warning shots at United States warships in the Gulf of Oman on June 5th. The same session silver hit its weekly low per bullion vault. The Strait of Hormuz, a passage carrying roughly 1/5 of global oil shipments, remains a central point of leverage in ongoing United States-Iran negotiations, with the Iranian regime deliberately linking the Lebanon ceasefire talks to the broader Strait of Hormuz framework, per Critical Threats. Brent crude showed a weekly rise of 3.9% through June 5th, despite slipping on that specific day. Elevated oil prices feed directly into inflation, which feeds into Federal Reserve hawkishness, which feeds into the dollar, which feeds into the paper silver price. Silver is now being crushed by two forces simultaneously: the war premium that should support it, and the inflation premium it creates that works against it. Both of those things are true simultaneously. Year on year, silver is still 87% higher than this date in 2025. Each holder type is navigating a different version of this market right now, and the specific data tells a specific story for each structure. PSLV, the Sprott Physical Silver Trust, was trading at approximately a 4.78% discount to net asset value as of mid-May 2026, according to the Motley Fool, widening toward 5.6% by late April per company's market cap data. That discount is the closed-end fund structure doing what it always does when investment sentiment softens. The units trade below the value of the physical silver backing them, which means PSLV holders are currently sitting on a structure worth more in metal than the market is pricing it. The level to watch is whether that discount narrows back towards zero as the delivery cycle tightens physical availability. SLV tracks spot silver mechanically with its open-ended structure and suffered the full 8.86% session loss on June 5th with no structural buffer. A GQ, the 2 times leveraged ProShares Silver Fund, amplifies every directional move. A session like Friday's represents approximately 17 to 18% in a single day at full leverage, which means the confirmation level for AGQ holders is whether silver reclaims and holds $70 before Warsh's June 16th FOMC meeting. Physical holders face the most straightforward picture. The gold to silver ratio currently sits at approximately 63 to 1. Gold at $4,342 divided by silver at $68.57, against a historical average of 47 to 1, meaning physical silver is historically cheap relative to gold right now at this specific price. 3 distinct forward paths exist between now and the close of the June delivery window at month end, and the specific vault number tells you which scenario you are actually entering. Scenario 1, physical delivery demand in the June cycle accelerates beyond the 2,820 contracts already standing. The registered pool draws below 80 million ounces, and the coverage ratio breaks decisively under 14%. That combination, against an open interest level that has remained flat, produces the conditions where eligible to registered conversion becomes the only pressure valve and vault owners control the pace. Scenario 2. The macro story dominates cleanly through June 16th and 17th. Paper open interest continues rolling rather than standing for delivery. The June delivery count stays contained near current levels, and silver trades sideways to lower in a range between $65 and $72 while rate hike risk reprices. Scenario 3, an external catalyst overrides both simultaneously, a Strait of Hormuz closure incident, an Iranian Navy escalation beyond warning shots, or a surprise dovish signal from Warsh at the June meeting that collapses rate hike probability in a single session. The number that tells you which scenario is active is the registered vault figure published each business day by CME Group. Watch the number, not the headline. 80 million ounces registered is the threshold. Below it, Scenario 1 becomes the dominant path. The full framework for navigating each of those 3 scenarios, including the session-by-session vault threshold map, the open interest countdown through the remainder of June, and the specific price levels each holder type needs to watch through the Warsh meeting, lives inside the members' room where the complete playbook is updated after every session. The one data point from the most recent COMEX session that the public conversation is not discussing is this. The vault growth that occurred in the days before May 29th first notice day, when registered climbed to roughly 85 million ounces, came almost entirely from eligible metal being redesignated as deliverable, not from new silver entering the COMEX system from outside. That distinction matters because it means the total COMEX silver supply did not grow. Metal simply changed its legal classification to satisfy anticipated delivery demand. The eligible pool, the 234 million ounce reservoir that everyone points to as the backstop, shrank to fund the registered growth. Watch whether that conversion pace continues through the final weeks of June. If eligible to registered conversions slow while delivery notices continue arriving, the registered figure will draw down faster than the headline vault total suggests. And the coverage ratio will tell you the truth before the price does. The structural picture underneath every delivery cycle, every coverage ratio reading, and every paper price collapse is the same number, 46.3 million ounces. That is the Silver Institute's projected global silver supply deficit for 2026, the 6th consecutive annual deficit, up from 40.3 million ounces in 2025, a 15% widening of the shortfall in a single year, according to Bloomberg. Since 2021, 762 million troy ounces have been drawn from global above-ground stocks to cover the gap between mine supply and total demand, per Reuters. Global mine production for 2026 is projected at 820 million ounces against total demand that continues to exceed total supply. Silver is consumed permanently in solar cells, semiconductors, electric vehicle components, and medical devices, and that consumed metal does not return to the vault. Every delivery cycle runs against a shrinking physical foundation. The COMEX registered pool today at 84.6 million ounces represents a 50% reduction from 8 months ago. The coverage ratio has held below the 15% stress threshold for 6 consecutive months. Silver is still up 87% year on year, even after Friday's 8.86% session loss. The 46.3 million ounce annual deficit does not care what Kevin Warsh says on June 16th. Drop one final comment. Tell me exactly what you are holding and where you are watching from, because before the next session opens, I want the full picture of who is in this market with us right now, and the vault number that matters most to all of you is the one CME Group publishes tomorrow morning.